The $14 billion consolidation play. Uber just committed $14.8 billion to acquire Delivery Hero, a company that has spent a decade burning through investor cash across Europe and Asia. This is not a bold expansion into new markets, but a calculated consolidation of a failing business model. By absorbing its largest global rival, Uber is betting that removing the competition is the only way to stop the perpetual marketing wars that have crippled delivery margins since the pandemic. The price tag represents a massive premium for a company that struggled to prove it could ever be a standalone profit engine. The P&L shell game. Look past the narrative of global scale and examine the combined balance sheet. Delivery Hero's adjusted EBITDA has historically relied on aggressive accounting that ignores the massive cost of customer acquisition. Uber is paying nearly $15 billion for a business that effectively functions as a low-margin utility. The internal math only works if Uber can slash redundant operations and hike merchant fees across the Eurozone by at least 15% without triggering a vendor revolt. This isn't about technology. It's a pure play for pricing power in a market where loyalty is non-existent. The real story is the attempt to turn a variable cost nightmare into a fixed cost monopoly. The Duopoly Infrastructure Tax. This deal effectively carves the world into a delivery duopoly between Uber and DoorDash, leaving regulators with a difficult choice. In Washington and Brussels, the argument will be that this merger provides stability to the gig economy, but the reality for restaurant owners is a shrinking list of platforms. Uber is positioning itself as the unavoidable infrastructure of urban life, similar to a public utility but with private sector margins. Think of it as a global tax on every meal delivered. If the regulators let this pass, the era of the subsidized $5 delivery is officially dead, replaced by a permanent service fee that fuels Uber's bottom line. This brings us to the actual endgame for the delivery industry. The signal under the noise. Uber's massive acquisition confirms that the independent food delivery model is fundamentally broken without total market dominance. By folding Delivery Hero's P&L into its own, Uber is signaling that organic growth has hit a ceiling and the future is about extraction rather than expansion. This move transforms Uber from a high-growth tech platform into a global rent-seeking entity that survives by controlling the logistics of the last mile. For investors, the takeaway is clear. The days of subsidizing your dinner are over, and the phase of squeezing margins from restaurants and drivers has begun. This is a defensive pivot disguised as an aggressive takeover, designed to hide the fact that delivery alone cannot sustain Uber's valuation. Watch the combined take rates in the upcoming Q3 earnings call. If they don't climb by at least 200 basis points, Uber just paid $14.8 billion to inherit someone else's loss-making problem. Subscribe for more